UK Mortgage Warning 2026 New Rules. Could impact your approval. Imagine this. You have been saving for years. You finally found the perfect home. You walk into that estate agent's office with confidence, you submit your mortgage application, and then you get a letter back saying, declined. No explanation that makes sense, no second chance, just declined. And the worst part? It wasn't because you didn't have enough money. It wasn't because your credit score was bad. It was because of a rule change you never even heard about. This is happening to real people across the UK right now. And in 2026, it is about to get even more serious. Stay with me till the end of this video, because what I am about to share could genuinely be the difference between getting your mortgage approved or walking away empty-handed. Whether you are a first-time buyer, someone remortgaging, or an overseas investor looking at UK property, this video is for you. Welcome to NestPath UK, the channel where we cut through the noise and give you real, honest, actionable information about the UK property market. If you are new here, make sure you subscribe and hit that bell, because this kind of content could save you thousands of pounds. Let's get into it. The UK mortgage market is going through one of the most significant shifts it has seen in over a decade. Lenders are tightening, regulators are introducing new frameworks, and millions of homeowners and buyers have absolutely no idea what is coming. Now, before I tell you exactly what the new rules are, I want you to understand why this is happening. Because once you understand the why, everything else makes complete sense. Cast your mind back to 2022 and 2023. Interest rates in the UK went from near zero to over 5% in what felt like overnight. The Bank of England was fighting inflation, and suddenly millions of people who had taken out mortgages when rates were low found themselves remortgaging at rates double or even triple what they were used to. Mortgage stress became a real and painful reality for hundreds of thousands of households. The Financial Conduct Authority, the FCA, the body that regulates how lenders operate in the UK, watched all of this very carefully. And their conclusion was this: the system needs stronger guardrails. Lenders need to be more careful about who they lend to, and borrowers need to be better protected from taking on debt they cannot sustain. So they went back to the drawing board. And what came out of that process is a series of updated mortgage lending rules that are now being rolled out and tightened through 2025 and into 2026. Here is where it gets really important, so I need you to focus. The first major shift is around affordability stress testing. Now, stress testing is not new. Lenders have always tested whether you can afford your mortgage if interest rates go up. But the way they are doing it in 2026 has changed significantly. Previously, many lenders were stress testing at around 3% above the product rate. So if your mortgage rate was 4%, they would check whether you could afford payments at 7%. That was already quite strict. But now, some lenders, especially those following updated FCA guidance, are pushing that stress test even higher and applying it more rigorously across different income types. What does this mean for you? It means that even if you earn a solid income and have a great credit score, the amount you can borrow may be less than you expect. Someone who qualified for a $250,000 mortgage 2 years ago might only qualify for $210,000 or $220,000 today under the same salary, purely because of how the stress test has changed. And here is the part that catches people completely off guard. This does not just affect new buyers. If you are coming to the end of a fixed rate deal and you want to switch to a new product, even with your existing lender, you may now face a fresh affordability assessment. That is a big change from how things worked before. Let me tell you about a situation that is becoming increasingly common. Someone took out a 5-year fixed mortgage in 2019. Great rate, comfortable payments. Life was good. That deal ended in 2024. They went back to their lender expecting a smooth switch. Same lender, same property, same borrower, and they were told they needed to go through a full affordability check again. Their income had not gone down, but because the stress test thresholds had changed and their outgoings had increased over 5 years, a car payment here, a subscription there, a slight increase in childcare costs. They no longer met the new criteria with the same lender. They had to scramble to find an alternative. They got one, but at a higher rate than they anticipated. This is not a horror story to scare you. This is a real scenario playing out across the UK right now. And the people who know about it in advance are the ones who can prepare and protect themselves. Now let's talk about the second major change. And this one affects a huge number of people who think they are completely safe. Self-employed borrowers and people with variable income are facing a dramatically tougher landscape in 2026. The new guidelines require lenders to take a more conservative view of income for anyone who is not on a straightforward pay salary. If you are a contractor, a freelancer, a business owner, or someone who earns bonuses or commission, listen very carefully. Previously, many lenders would look at your last 2 years of accounts or tax returns and average them out. If year 1 was okay and year 2 was strong, they would use a generous average and you would be fine. Under the new approach, some lenders are now required to look at a broader picture, including consistency of income, sector risk, and future sustainability. If your income varies significantly from year to year, that variation itself becomes a red flag, even if your overall numbers look good. For overseas investors and non-UK residents looking to buy in the UK, and I know a significant portion of the NestPath UK audience falls into this category, the rules are also becoming stricter around proving source of funds, income verification from overseas, and currency risk assessment. Some lenders who previously worked comfortably with overseas buyers have quietly tightened their criteria or exited that market altogether. This is why having the right broker, someone who specializes in your specific situation, is no longer optional. It is absolutely essential. All right, I promised you this video would be practical and actionable. So let me now shift into what you can actually do with this information, because knowledge without action is just anxiety. Step 1, and I cannot stress this enough, check your credit file right now. Not tomorrow, not next week, today. You can do this for free through services like Experian, Equifax, or ClearScore. Look for any errors, any missed payments that should not be there, any accounts you do not recognize. Even a small error on your credit file can trigger a rejection under the new stricter assessment frameworks, and correcting errors can take weeks or even months, so you need to know early. Step 2. Reduce your visible outgoings before you apply. Lenders are now looking more closely than ever at your bank statements, typically the last 3 to 6 months. What they are looking for is patterns. Gambling transactions, even small casual ones, are a major red flag. Frequent overdraft usage, large unexplained transfers. Buy now, pay later purchases, which many people do not realize show up and affect assessments. Subscriptions you have forgotten about. All of these create a picture of your financial life, and you want that picture to look as clean and stable as possible. So in the months before you apply for a mortgage, tighten up. Cancel the subscriptions you do not use. Avoid any gambling transactions even if they are recreational. Try to stay well within your overdraft limit or avoid using it altogether. Build a clean, consistent, predictable pattern of income and spending. Step 3. Understand your debt-to-income ratio. This is a metric that lenders are increasingly focused on. It looks at your total monthly debt obligations, credit cards, car finance, personal loans, student loans, as a percentage of your gross monthly income. The lower this ratio, the stronger your application. If you have credit card balances you can pay down before applying, do it. Even reducing a balance from $3,000 to $1,500 can meaningfully improve your debt-to-income picture. Step 4. Get a mortgage in principle before you start seriously house hunting. This is something NestPath UK always recommends. A mortgage in principle, sometimes called an agreement in principle, is a conditional statement from a lender saying they would be willing to lend you a certain amount based on an initial assessment. It does not guarantee final approval, but it gives you a realistic budget to work with. And in a competitive property market, sellers and agents take you much more seriously if you already have one. Step 5. And this is the big one: work with a whole-of-market mortgage broker, not a broker tied to one or two lenders. A whole-of-market broker who has access to hundreds of products and knows which lenders are most flexible for your specific profile. In 2026, with lending criteria varying so significantly between lenders, this expertise is worth every penny of whatever fee they charge. And often they do not charge you directly at all because they earn commission from the lender. Now I want to address something that a lot of people in the comments and DMs have been asking about. What happens if you are already in the middle of a mortgage and your fixed rate is ending soon? This is one of the most urgent situations right now. If your fixed rate deal is ending in the next 6 to 12 months, you need to start exploring your options now, not when the deal expires. Here is why. When your fixed rate ends, you typically roll onto your lender's standard variable rate, or SVR. And SVRs in the current environment are significantly higher than competitive fixed-rate products. We are talking about the difference between paying 4.5% and paying 7 or even 8%. On a $200,000 mortgage, that difference is hundreds of pounds every single month. The good news is that most lenders allow you to lock in a new rate up to 6 months before your current deal ends, without penalty. So if your deal ends in September 2026, you can start securing a new rate from March 2026. And if rates drop between now and then, many brokers can switch you to a better deal before completion. You get the benefit of acting early with the flexibility to improve if the market moves in your favor. Do not wait. Do not assume your lender will automatically give you the best deal. Shop around, use a broker, and lock something in. Let me also quickly address the new rules around green mortgages and energy efficiency, because this is an emerging area that will only grow in importance. The UK government has been pushing hard for homes to meet higher energy efficiency standards. There is ongoing pressure for buy-to-let landlords in particular to ensure their properties meet minimum EPC, Energy Performance Certificate, ratings. And in 2026, some lenders are beginning to price mortgages differently based on the energy efficiency of the property. Homes with higher EPC ratings, A, B, or C, may qualify for slightly better rates or more flexible criteria. Homes with poor ratings, E, F, or G, may face additional scrutiny. If you are buying an older property or one that needs work, factor in the cost of improving its energy efficiency. Not just because it might be legally required in the future for rental properties, but because it could directly affect your mortgage options and your monthly costs. This is the kind of joined-up thinking that separates smart property investors from people who get caught off guard. Here is the big picture truth that I want to leave you with. The UK mortgage market in 2026 is not impossible to navigate. It is not a closed door, but it is a door that requires the right key. And that key is preparation, knowledge, and the right professional support. The people who will succeed, the first-time buyers who get approved, the investors who secure great deals, the homeowners who remortgage smoothly, they are not necessarily the richest or the luckiest. They are the most prepared. They know the rules. They have clean finances. They have the right team around them. And they took action early. That is exactly what NestPath UK is here to help you do. Every week on this channel, we break down the UK property market in a way that is honest, practical, and built for real people, whether you are based here in the UK or you are investing from abroad. If this video gave you value today, and I genuinely hope it did, please give it a thumbs up. It takes 1 second and it helps this content reach more people who need it. Drop a comment below and tell me, are you a first-time buyer, a remortgager, or an investor? I read every single comment and I use your questions to shape future videos. And if you have not subscribed to NestPath UK yet, what are you waiting for? Hit that subscribe button and the bell icon right now so you never miss a video. We are here every week with content that could genuinely change your financial future. This is NestPath UK, your path to property in the United Kingdom. I will see you in the next one.